Hey everybody, welcome back to this video where we will be presenting the top 5 aerospace and defense stocks. I think it's going to be really interesting to run over these 5 companies that we have selected for you. The first one is General Dynamics, stock ticker GD. The next one is Raytheon Technologies, stock ticker RTX. Then we have Lockheed Martin, stock ticker LMT. We have Northrop Grumman, stock ticker NOC. And finally, we have the Boeing company, stock ticker BA. So first, we want to take a look at how these stocks have been performing in the most recent periods and whether they are in what we consider an up or downtrend. So if we take a look across the board here, we will see that year to date, more or less all the stocks have lost value. So GD down with 20%, RTX down with 37.52%, LMT the only one up with 0.29%, NOC down with minus 4.20%, and BA has lost 49.02%. So except with LMT, we would consider all these companies to more or less be in a downtrend. Then we want to take a look at whether these companies are earning money in the end of the day. Are they profitable? So first we can look at the net income for the 12 last months, and we can see here that all of them, with the exception of Boeing, BA, has actually earned money, so that's a good sign. If we take a look at the net profit margin average for the last 4 quarters, GD doing fairly well with 8.41%, RTX down with 4.44%, LMT above industry average with 10.26%, so that's really good. NOC fairly well with 6.93%, and then BA down with 5.9%, so really bad. Then we can look at the BNHM score, which is a mathematical model that determines whether a company has manipulated its profits, and we want this to be below minus 2.22. And as we can see, GD, RTX, and NOC are doing fine, while as BA are in the red here with 0.71. Then we have the Sloan ratio, which can identify if a substantial part of the earnings are non-cash accruals, and we are obviously not interested in this. We want this number to be between minus 10% to 10%. And again, looking across the board, it's looking fairly well with the exception of BA, which has above 10% on 15.17. Moving into the ranking overview, we first look at the trend part, and what we saw were that all companies, with the exception of LMT, were in downtrend. On the net income for the last 12 months, all of them were positive with the exception of BA. And finally, on the net profit margin, LMT were the best, followed by GD, NOC, BA, and finally RTX. Next, we move into the return metrics, and we want to understand how high return to cash flow margin is being generated by the companies. So if we first took a look at the earnings yield, we see that GD has a very nice 7.99, RTX very poor in 0.7, LMT and NOC with respectively 584 and 433. That's all right, and BA with a minus of 3.03%, so really poor. On the return on invested capital benchmark against the industry, we see the GD is performing poorly here on 6.15, but not too bad compared to RTX, which is down with 9.33, really poor. LMT doing better than the others on 15.56, NOC 8.7, and BA really poor again here with 8.62 minus. On the levered free cash flow margin, we see that GD and RTX are doing around 6%, which is all right. LMT and NOC really well here with 10%, and again BA with the minus on 23.9%. Then we move into the balance sheet, and we want to understand how strong is their financial position. And if we take a look at the current ratio first, we want that to be above 1, and we can see that all of them are in the green light. Then we have the cash ratio, which we also like to be above 1, but which may not be for these capital intensive industry, they may not have a lot of hand, and I think that's why we have very low numbers here, so I would take them with a grain of salt. If we move to the total assets versus total liabilities, very important one, want that to be above 1.5, and we can see it's a little bit mixed results here. The best one is RTX with 1.74, while as the worst one is again BA with with 0.93. On the debt equity ratio, again, really important here. GD doing fine, RTX doing really fine, L&T doing really poor. That's usually a red flag to me, but I went to check that specifically, and what I can see is that L&T has reduced this over the last 2 years, so that gives me some comfort. NOC fine with 1.61, and BA doing really poorly here with minus 5.14. If we move to the Altman Z score, that is a credit strength test that assesses the likelihood of bankruptcy. We want that to be above 1.8. And with the exception of RTX, which is close to, and BA is looking fine across the board. On the Piotrowski score, it's another way to assess the strength of the financial position of the company. We want that to be 5 or above. And here they're all doing fairly fine with the exception of BA, which only scores at 2. So moving back into the ranking overview, we first look at the return on invested capital, and what we saw was that LMT were the best, followed by NOC, GD, BA and RTX. Almost the same story on the levered free cash flow margin. Here the only difference is that RTX is doing slightly better than BA, otherwise it's the same across the board. Moving into the balance sheet, on the tattle ratio, RTX was doing the best, followed by GD, NOC, LMT and finally BA. And again, the full same story on the debt equity ratio, the same scoring for each bidder. We then want to take a look at the shareholder yield and understand how much value is returned to shareholders through either dividend and or buyback. And if we take a look at the dividend yield, we can see compared to the industry that all of them are above industry with the exception of NOC. On the buyback yield, it's a bit different. GD is paying all right, RTX very small compared to the S&P 500 average, LMT and NOC are above, and BEA were the only one who actually had a negative buyback yield, which means that they issued more shares. So the total shareholder yield here is actually looking fairly good for all companies, between 3 to 5%. But we want to understand if this is sustainable, so we take a look at the modified payout ratio, which shows the proportion of earnings paid to shareholders in the form of dividends and buyback. We want this to be below 100. Because that means that it's sustainable going forward, and we can see that it's looking really good here with GD, RTX, LMT and NOC, really good numbers. That means that there are room for growth in the future or to pay out more dividend and a buyback to the shareholders, while as BE is a bit more of a concern here with 145%. That means that it's not sustainable in the long term. Then we go into the earnings per share and growth, and we want to understand whether these companies are expected to grow in the future. So we look at the EPS growth forecast for the next 5 years, benchmarked against the industry. GD not doing too well with 3.88, RTX doing extremely poor with 13.25. That's a bit red flag. LNT okay, 9.11%. Same with NOC, 8.62. It's not fantastic, but it could be worse. And BA doing the best with 12.33%. However, that could be related to that their starting point is a bit lower because they have been performing so poorly. Then we take a look at the revenue growth for the past 5 years. You cannot use the past to predict the future, but I still think it tells a story how these companies are in general managed, and this is a way to look at that. And as we can see across the board, it's quite good numbers, especially LMT, and with the exception of BA, which has lost 5.08%. Back in the ranking overview, we first look at the total shareholder yield, and based on my own assessment, I believe that the best one is NOC, followed by GD, RTX, LMT, and then in the end BA. Then we have the EPS growth forecast for the next 5 years. We saw that BA was the one doing the best, followed by LMT. And on the revenue growth, LMT is doing the best, followed by RTX and NOC. So looking at this, it shows a clear trend here that BA is performing really poor compared to its competitors. We then want to move into the understanding of whether these companies are actually under or overvalued, and we have different ways to do that. One of them is to look at the PEG ratio and its connections to Peter Lynch fair value. We want this number to be below 1 because it means that they're undervalued, and above 1 they are considered overvalued. So GD overvalued, RTX we cannot assess because the earnings growth forecast is negative, LMT overvalued, NOC overvalued, and BA we cannot assess because they have a negative PE ratio. Next, we can look at my own estimated intrinsic value that is based on several different assumptions and numbers. And what we can see here is I believe that there's an upside on 13.22% on GD. RTX is more or less fairly valued on 0.75% upside. LMT, nice here with 8.88%. NOC, a small 2.4%. And BE is also fairly valued, but a small minus on 1.72%. You can also look at the beta risk, which is basically a ratio that shows the stock's volatility in relation to the overall market. If it's above 1, it is more volatile than the market. Below, it is less volatile. And as we can see here, RTX and BA are more volatile than the general market. Next, other value indicators, we can look at the book value. And in general, this is very rare that you see companies that are undervalued from this perspective. However, we had a case in the most recent video, but we can see that all of these stocks are considered overvalued according to this. On the relative strength index for the last 14 days, we want this number to be below 30 because that means it's oversold. And if it's above 70, it's considered overbought. We don't want that. All the companies are in the middle range here between them, so no clear indications of whether they are either oversold or overbought as of today. Then finally, we can also look at the analyst recommendation. And again, I don't take them for granted. They often have their own agenda, but it's always good if the analysis leads to the same conclusions as the analyst, because they can sometimes do movements in the market. So if we look across here, we can see that for GD, there's a price target upside estimate on 26.64. On RTX, a high 60%. I feel that this is too much. I don't agree with this. LMT, more fairly here with 14.81. NOC 21%, also fairly okay, and 25.6 upside on BA, which I also have some doubts about. Again, this is based on the middle ground estimates. There will be some that has lower and some that has higher, so it's kind of like the average. So based on all the parameters and numbers we just saw before, my overall value assessment of these companies is that GD is considered undervalued, RTX is fair valued, LMT undervalued, NOC undervalued, and BA fairly valued. The analyst may not agree with that. However, this is my view on these stocks. So based on all the information that we have gone through, this is the CMD top picks for today. And it was actually a pretty clear-cut winner for us based on the overall trade-off between the numbers and the value potential. So based on an above industry net profit margin of 10.26%, highest free cash flow margin of 10.29%, managed to reduce debt equity in the past 2 years, currently attractive dividend and buyback yields, attractive growth forecast and value potential, we have selected Lockheed Martin as our top pick. The CMD other pick will be NOC Grumman, which also has very solid numbers and should be a safe choice. This was all we had for today. We hope you enjoyed. Please provide a comment if you have suggestions for improvement. Like is also appreciated, and of course sharing the video. Please check out our Patreon site for additional content. There's a lot of great value to be found there. Otherwise than that, have a nice day.